Friends, I welcome you all to our this session. This session will be talking about two things. One is hire purchase, and one more thing is leasing. So, while managing the business, many times the businessman has to take a decision whether to buy asset. If he's planning to buy asset, it's definitely an investment decision. It involves a huge sum of cash outflow. So many times the company may not be in a position to opt for that. But many situations also it may not be wise to invest money in a new asset. So alternative options are available. Instead of buying asset, one can still use the asset. How it is possible? One can take the asset on lease. That is one option. You can use the asset and you don't have to pay money in a lump sum. Okay, you have to all that you have to pay as pay at a rent, and this rent amount can be allowed as an expenses also. So that will reduce your profit. You will be saving tax on that also, right? And if you buy, you got the advantage that you can claim depreciation. And instead of buying or let's say leasing, you can one more option is available that you can go for hire purchase. If you hire purchase, then in fact technically you can also claim depreciation because you almost become owner, but technical ownership will come only when you pay the last installment. It has got lot many advantages. There is no huge capital outflow at the beginning in case of hire purchase, but hiring charges has to pay. So this is an important decision when many businesses faces. So in this lecture, we'll try to understand at a very basic level in what is that leasing concept and what is the hire purchase concept. Okay, going to share the screen with you right now. First, let us understand the concept of lease. Okay, so when you talk about the lease, it is an arrangement between two parties. Minimum two parties are involved. One is the leasing company. The leasing company will be called as the lessor. His leasing is called as the lessor, and the user will be called as the lessee. So this is a contract between the lessor and lessee. Right? Lessor means the leasing company, and lessee means the user. And the farmer means the leasing company or the lessor arranges to buy capital equipment for use of the latter. The farmer is the owner and the latter is the user. And the lease period has a defined time. It is for agreed period of time. And what will happen? The user will be paying lease rent to the owner. And these lease rentals are normally predetermined, and it may be flexible also. There might be option for incremental rent. That possibilities are also there, and they're paid on a fixed installments, maybe monthly, maybe annually, maybe quarterly. Okay, so lessor becomes the owner of the asset. That means the leasing company becomes the owner of the asset in case of a normal lease we are talking. Okay, I think you got a fair idea about the concept of lease. It has got advantages, many advantages. First of all, your money is saved. That money can be used for alternative use. For alternative purpose, you can use. Suppose you are doing a business, you are supposed to buy some asset. The same fund can be used elsewhere. But still you can use the asset by leasing it, by taking the asset on lease. And it's a faster and cheaper way of obtaining credit. Rentals can become flexible depending upon the cash flow availability of the lessee. And it will also facilitate additional borrowing if later on, if required, borrowing can be increased. It's a protection against obsolescence. Suppose the asset will become obsolete, then it is not your problem. Owner is the lessor. So that is the advantage. It's a protection against obsolescence. Then no restrictive covenant of restrictive covenants such as debt equity ratio. Let us say you are applying for a loan. So there are certain issues that you have to have a fixed debt equity ratio. You have to offer some securities. You have to enter into various kind of complex agreements. Those issues are not there. Maybe sometimes also conditions like this, the lender may participate in the board. That kind of restrictive covenants might be there. But in case of lease agreement, normally those conditions doesn't exist. And in case of lease, it is 100% financing. There is no down payment is also required. For more small farms, it's a big blessing. Okay, small farms may not be having on certain recording, certainty of earning. So what happens? Small farms, so they may not be willing to take a high risk of investing money in a big asset. So they may go for leasing option. So these are the advantages. Now coming to various types of lease. So broadly, two types of lease are there, but some incidental other types of leases are also there. First one is, we'll be calling it the finance lease. That is also called as capital lease, long-term lease, or net lease, or close lease. All these are the names only, but normally it is understood as the finance lease. Here what happens? The lessee selects the equipment. So basically it's a financing arrangement. The lessee, that is the user, is selecting the equipment and settles the price in terms of the terms of the sale, arranges with the leasing company to buy. So that means lessee is doing everything, but leasing company will be buying that asset. Then he enters into an irrevocable contractual agreement with the leasing company. Right? Then that means through leasing company he obtains that equipment. The lessee uses the equipment, maintains it, insures it, avails after sale services and warranty, because everything is done by the lessee. Technical ownership is with the lessor. Okay, money is paid by the lessor, but which machine is to be selected? It's the lessee's decision, and lessee maintains it, insures it, avails warranty. Lessee bears the risk of obsolescence as it stands committed to pay rent for the entire lease period. So it's an irrevocable contractual agreement. That means it cannot be revoked. So the lessee has to pay for the entire lease period, he has to pay the lease rate. Okay. Finance lease, normally, or most of the cases, they have the purchase option. That means at the end of the lease period, if lessee wants, he can purchase it at a nominal value, at a predetermined value. Generally, these leases are not cancelable. This is called as the finance lease. Okay. Understood? So this is basically a financing arrangement. Somebody wants a machine, but he is getting it financed with a leasing company or a lessor. The other type of lease is operating lease. They're also called as the service lease, or called as the short-term lease, or true lease. It is only for operating lease, only for operation purpose. Right. So the contractual period between lessor and lessee are again fixed. Normally, the contractual period, the life of the contractual period is less than the full expected economic life of the asset. Suppose life of the asset is, let us say, 20 years. The contractual period may be for 5 years. Right. Lease is terminable by giving stipulated notice. If anybody wants, lessor wants, or lessee wants, they can terminate the lease. Lease rentals are normally higher as compared to finance lease. It's a purely operational lease. Once the lease period is over, asset will be handed over. Lease rentals are normally higher. Risk of obsolescence with the lessor. Lessors take the risk of obsolescence. That means if the asset becomes obsolete, the lessor has to face the consequence. Right? He has to bear the cost or the relevant cost. Maintenance is also with the lessor, not with lessee. In a finance lease, it is with lessee. But operating lease, it is with the lessor. Lessor also maintains it, makes warranty claims, pay taxes, etc. So these are the responsibility of the operating lease. So broadly, if you say these are the two categories of leases, operating lease and finance lease. So let us try to differentiate. Finance lease is just like an installment purchase. Meaning your asset, you are purchasing an installment. Instead of installments, you are paying lease. But operating lease, you are only using the asset for operation. You have to pay the monthly lease rentals. It is like a rental. In case of finance lease, maintenance and taxes are borne by the lessee. Operating lease, it is borne by the lessor. Risk of obsolescence is assumed by the lessee in case of finance lease. And it is assumed by the lessor in case of operating lease. Contract period ranges from medium term to long term in case of finance lease. Finance lease contract terms are normally long, but in operating lease, it is for very short term. Financial commitments are smaller to loan in case of finance lease. Financial commitments are restricted to the rent payment in case of operating lease. Operating lease, the lessee is only has to pay the rent payment. That is his financial commitment. Examples of finance lease like leasing of aircrafts, land and building, heavy machines, etc. Operating lease examples normally computer on lease, office equipment on lease, vehicles on lease. Okay. In case of finance lease, lessor fulfills financial functions. In case of operating lease, lessor fulfills service functions. Finance leases are normally not cancelable, but operating leases are normally cancelable. Okay, this is the difference. You can have a look at this. If any query you have, you may ask. Any query you have?
No, sir.
Okay. In addition to this type of leases, there are some other type of leases are also there. But finance lease and operating lease are the main two types. One kind of lease can be called as the leverage lease. Leverage lease is this is the kind of lease where three parties are involved. One is lessor, lessee, third one is lender. Here what happens? Lessor acquires the asset as per the lease term. Okay, lessor is acquiring the asset, but finance is only a part of the total investment. Balance is financed by the financier or lender. Balance is provided by the lender in terms of the loan to lessor. That means the lender will give a loan to the lessor, and lessor will buy the asset, which will be used by the lessee. This is how this happens. This is called the leverage. So in financial management, you must have understood the concept of leverage. Leverage means introducing some kind of debt. Here also use some kind of debt which is introduced in the lease structure. Therefore, it is called the leveraged or leveraged risk and leveraged lease. Okay. Lender gives me to the lessor and lessor gives the asset to lessor. So lender finance normally to the extent of 75 to 80% of the asset. Okay, and the asset is secured with the lender. This is the concept of leverage lease. Sale back lease is one more kind of concept for what happens. Asset is sold and again leased back. So what a person can do, one can acquire an asset. Suppose you need a vehicle or need a heavy machine, you can acquire it. Okay, then you sell it and get it back on lease. Or if in case you are having an asset, you can sell it to someone and get it back on lease. It has got two advantages, because when you're selling, you are getting a cash inflow that will help you to run the business. Okay, and you can use the asset by taking it on lease, by paying lease rentals. That means you will get a big inflow of money, but outflow will be in small installments. So that will be helpful in managing your business cash. So that is again a financial management plan, sale and lease back capacity. Okay. Cross-border lease means when parties are located into different countries, that is called as the international lease or cross-border lease. Coming to the evaluation of lease, when you're taking a lease decision, we need to evaluate the lease proposal. It is basically, now you have understood, it is a investment decision as well as, or you can call it as a financing decision also. So on that angle, one has to evaluate whether buying a asset is profitable or taking a asset on lease is profitable. Both the options one can evaluate by computation of net present value and evaluating the advantages one has to see. Okay, if you go for the purchase of asset, then the cost of capital is also involved. That aspect has to be taken care of. Keeping all this in mind by comparing the cash flows of buying and leasing, one can compare both the cash flows and one can compute the NPV of both the situation and compare them. And where NPV is higher, that proposal should be acceptable. Okay, and this can be evaluated from lessee's point of view or from lessor's point of view. From both the point of view, cash flows needs to be evaluated. On that basis, decision has to be taken whether the lease is better or not. Friends, this is about lease decision. Okay, leasing versus buying, this decision often comes in any company, that whether you should buy an asset or lease an asset. That also by analyzing the cash flows, one takes a decision whether to buy it or take the assets. Lease had got disadvantages also. There is a commitment to pay fixed money. Okay, there will be, one cannot claim depreciation like this. Disadvantages are also there. So you can have a look at this slide. You can get some idea about this. What are the content of lease agreement, structure of the leasing industry? We are not covering that right now. Now, here we'll be moving to the next concept that is called as hire purchase arrangement. Hire purchase is like selling goods. It's a method of selling goods. Okay. So what happens here? The goods are let out on hire by financing company to the customer. Customer in fact acquires the goods on hiring basis. But when he pays, he keeps on paying the periodical installment for a given period. And the last installment is paid, customer becomes the owner. Okay, customer becomes the owner. Okay, okay. In the running please, you can, if you have done some annotations, you may remove it. Okay, now just a minute. Right. So these are some of the features of hire purchase scheme, and this is according to the Hire Purchase Act 1972. These features are noted. So here what happens, the buyer takes possession immediately and pays the hire purchase price in installments. Each installment is treated as the hire charges. Ownership passed to the hire purchaser on payment of the last installments. If default is made in payment, the seller is entitled to take away the goods. Seller can recover the goods if buyer makes some default. Hire purchaser is free to return the goods without being required to pay the further installments falling due after such return. These are the features as per Hire Purchase Act. This is a feature of the scheme. So, what is the content of the hire purchase agreement? We need not study at that point of time. We need to differentiate between hire purchase and installment purchase. They are in fact two different schemes. In case of installment purchase, what happened? Just a second. Yeah, the basic difference between hire purchase and installment purchase is that in case of installment purchase, what happens? If the buyer stops payment, the seller has no right to repurchase the good. In case of hire purchase, the hire purchase hirer or HP hirer has the right to terminate the contract at any time before payment of last installments. And in case of installment purchase, ownership passes immediately. In case of hire purchase, ownership passes when the last installment is paid. This is the difference between hire purchase and installment purchase. Okay, so now I think you'll be able to differentiate between hire purchase and leasing. In case of leasing, parties like lessor and lessee is involved. It depends who is the owner, who is the practical owner, depending upon the type of lease. Method of financing is different in case of hire purchase and leasing arrangement. Okay, so in case of hire purchaser can charge depreciation. In case of lease, depreciation, investment allowances, etc., cannot be claimed by the lessee. But hire purchase lessee can claim it. Entire lease rentals are expenses, but however, only the interest components are the expenses under hire purchase installments. This is how accounting has to be made. Lessee is not being the owner, doesn't enjoy the salvage value, but on hire purchaser enjoys the salvage value. So lease doesn't require any deposit, but hire purchase may require some deposit. Lease is a renting agreement, HV is a purchase agreement. Lease can give you 100% finance, hire purchase may not give you. Maintenance cost is borne by the hirer. Okay, like this, these are some differences between hire purchase and lease. So one can pause this video and read it to understand what is the differences, what is the hirer's obligation. Okay, now coming to evaluating a hire purchasing proposal. Again, one has to compare the cash flows. One need to compare the cash flows associated with the hire purchase scheme. One can compare the cash flows associated with the leasing scheme, and one can compare the cash flows associated with the buying scheme. On that basis, one will be able to decide that which option is better. But in a normal business, this kind of challenges come when we have to take a decision that money has to be invested or not. Whether we will acquire the asset by buying it, or will acquire it by leasing it, or will go for hire purchase scheme. Okay, so friends, we have tried to understand all these things at a basic level. Hope things are clear to you. If you have any query, you may raise it right now. Is it clear to you up to this?
Oh, yes, sir.
Okay, so thank you very much.